Imagine a scenario where the bond market is caught off guard by a surprise surge in producer price inflation, sending yields soaring. This is exactly what happened recently, and it's a stark reminder that even the most seasoned investors can be left reeling by unexpected economic twists. But here's the thing. The initial reaction to the 3.7% year-on-year producer price inflation reading was surprisingly muted, with yields rising by only low single-digit percentages across the curve. It seemed the market was thinking, it's just PPI, no need to panic. However, as the hours ticked by, the price action became much heavier and the aggregate reaction was quite considerable, with the 10-year yield up by almost 10 basis points and the 2-year yield also rising significantly. This begs the question, what does this mean for the future of the bond market? And how will it impact investors? And this is the part most people miss, the distinction between PPI and CPI readings, and how they can have vastly different effects on the market. A CPI reading of this magnitude would have garnered a much bigger market reaction, especially considering the 9% month-on-month reading on headline PPI. But why is that? And what are the implications for investors? As we delve deeper into the world of bonds and inflation, it becomes clear that understanding the nuances of these economic indicators is crucial for making informed investment decisions. The recent U.S. PPI reading, combined with Dutch pension reforms, is expected to push curves even steeper, leaving many to wonder what this means for the overall health of the economy. But here's where it gets controversial. Some experts argue that the market's reaction to the PPI reading was overblown, and that the true impact on the economy will be minimal. Others claim that this is just the beginning of a larger trend, one that will see yields continue to rise and the bond market become increasingly volatile. So what do you think? Do you agree that the market's reaction to the PPI reading was justified, or do you think it was an overreaction? Share your thoughts in the comments below. As we move forward, it's essential to keep a close eye on these economic indicators and their impact on the bond market. One thing is certain. The world of finance is never short on surprises, and being prepared for the unexpected is key to success. So stay tuned for more updates, and let's continue the conversation. The story doesn't end here, and we want to hear from you. What do you think is the most critical factor driving the bond market right now? And how do you think it will play out in the coming months?